What's up, everyone? Today I want to talk about 7 strategies that can save your portfolio during the next market crash. Okay, I learned a lot from this current market crash, and I'm going to tell you what I would do differently had I known then what I currently know now after this market crash. Let's go.
All right, folks, here are the 7 lessons I learned from this market crash that we just experienced. So lesson number 1, have a goal in mind when you're investing. This applies especially to growth stocks, okay? Do you want to grow a nest egg so you can put a down payment on a home maybe? I know in this current market, I actually lost something that a nest egg worth of money that would have paid for a good size home. That's now gone. Maybe you want to remodel your home, maybe up the value of your current home. Maybe you want to save some money to have a life-changing, amazing vacation. Maybe you want to put money on a Lambo or a 100K Benz or something like that. Maybe you want to cash out your high beta growth stocks and put that money into low volatility dividend stocks to de-risk. Okay, so and here's something else to think about. Maybe you want to use a target like an earnings multiple or price to sales ratio that will help you formulate a sell target, okay, a sell price. And when the stock gets expensive, you can de-risk and sell some or all of your stock. You also have to worry about taxes. What I learned, though, is it's better to pay taxes on gains rather than have no taxes to pay and have a loss, okay? So at the end of the day, you invest to make money, okay? Investing in growth stocks does not equal to dollar cost averaging into an index, okay? So if you're dollar cost averaging into the S&P 500, maybe selling at any point, as long as you're below the age of retirement, might be a silly idea because the market tends to rebound, right? But on the other hand, with growth stocks, some of these stocks that might hit, let's say it goes to $200, might not never ever reach that price again, and the stock could go to zero. And I want to show you a great example of that. Okay, and here's a great example of showing you a growth stock that went up high in value and has come careening down to $8. So I owned Fastly in the 20s. Fastly then skyrocketed in the summer. This is the fall of 2020 to about $130, almost $137. Okay, $136, $137. Since then, this baby has come down all the way to $8. Okay, so this is another way. Had I sold, at this point the price to sales was outrageous. The writing was on the wall that the stock was very expensive. So at that point, I think de-risking would have been a good idea.
Lesson number 2, have a hedging strategy. Does your portfolio have a hedging strategy? Mine did not. During the market run-up, since I wasn't hedged, I was able to make more money, but on the come down, I lost a hell of a lot more money unhedged. Another thing that I tried to do was in 2021, when growth stocks were down, growth stocks have been in an almost 2-year plus bear market. I started to short the SPY and the QQQs using call credit spreads. Meanwhile, the SPY and QQQ and the rest of the indices all made higher highs while growth stocks made lower lows, which brings me to my next point. Have a hedging strategy in mind that you know will work beforehand. I've put a link into the ARK hedging strategy that I've been doing recently. And for a growth portfolio, ARK is a good way to, if you want to short ARK, that's a good way to de-risk a growth portfolio. Lesson number 3, know your risk. Do you currently know how much portfolio risk you're carrying? If you do, that's great. If you don't, well, you were like me during the market this past year, during the market crash. So there's a couple different metrics, a couple different numbers you can use to identify how much risk you're carrying in your portfolio. One is the Sharpe ratio. I think I'm going to do a video on that soon. The other is the beta weighted delta. Okay, so that basically just tells you how long or short you are in comparison to. It basically takes your shares. Let's say you own 100 shares of Fastly. Looks at the beta correlation of that. So let's say Fastly has a beta number of 1.5. So basically every share of Fastly is going to be equivalent to 1.5 shares of the SPY benchmark. If that sounds a little complicated, I made a video about beta weighted delta. I will link to it here and put it in the show notes. And then also the other thing is, how correlated are all your holdings? Okay, so is your portfolio comprised of 100% growth stocks? Or do you have some balance to it? Do you have some energy stocks in there? Do you have some maybe dividend stocks that are much lower in volatility? So those are a couple things that are helpful to know. Lesson number 4, use stop loss orders. Do you use stop losses in your portfolio? I didn't during the market crash, and that hurt. One of the things you might not want stops. Okay, let's say you just invest in the S&P 500, you dollar cost average every month, every week, and you're just trying to accumulate shares. The stock goes down, you're happy it goes down because you're accumulating. You have a long time horizon. If you don't want to use stops for that, then I understand. But just like in that Fastly example, had I used a stop loss order, I would have captured a lot of my gains. So that's something to think about. The other thing though is when it comes to long-term dated options like leaps, use stops because one of my first ever videos I made on this channel was how I did a 4-leg multi-leg option contract, and I was long in Roku. Roku skyrocketed like $400 a share. I still had a lot to go. I could have gained more, but I had gained a lot of money on my leap, and now that leap has turned into one big giant loss, which is just it's just sad, really. So use stop losses if you got long-term dated options. Lesson number 5: try employing the wheel strategy. Okay, employ the wheel strategy on a few names in your portfolio. This will force you to buy low and sell high. Now, I wouldn't do this on more than 2 underlyings, 2 stocks in your portfolio. And the reason why is if you sell a put and you get assigned those shares, you're going to own 100 shares of stock, and that stock can go pretty low. So I would only do this with 1 or 2 names at the most, because this could blow up your portfolio. And another thing to keep in mind, during a bull market, this strategy will not perform as well as just owning stock, because what will happen is you'll sell calls and the stock will blow right through your calls, and you'll end up having to sell lower than where the stock price is going. And I did make a wheel strategy video that just goes over on how to run the wheel strategy using options. And last but not least, this is actually the last lesson. I only have 5 lessons for you, not 7. Sorry about that, guys.